All right, let's talk inflation. We're going to break down the latest CPI report, but not just the headline numbers. We're diving deep, using some incredible analysis from the Macro Butler to see what's really going on with the economy and, your money. So, here's the plan. First, we'll cover the official story. The one Wall Street was so happy to see. But then, we're going to start peeling back the layers. We'll look at the cracks in that story, figure out what's actually driving inflation, touch on the politics that are gumming up the works, and then wrap it all up with a solid playbook for investors.
All right, first up, the official story. These are the numbers that had Wall Street breathing a collective sigh of relief, or at least pretending to.
And on the surface, man, everything looked just perfect. The final inflation number for the year landed at a nice, tidy 2.7%. It was exactly what everyone expected, no surprises. It felt calm, orderly, just what the market ordered to cap off a pretty chaotic year.
But, of course, you and I know the headline is never the whole story, right? This is exactly where that official narrative starts to fall apart and the real analysis begins. So, you gotta ask, what was hiding underneath that pretty little 2.7% number?
Okay, let's start digging. Because once you get past that headline number and look at the actual components, you start to see that it's masking some pretty inconvenient truths.
So, you've got core CPI, that's the one without food and energy, and yeah, it shuffled down a bit to 2.6%. But here's the thing, you have to look closer. While some parts were cooling down, other parts were starting to wake up. Food and core goods, they actually posted their biggest gains in months. See what's happening? The pressure isn't gone, it's just moving around.
And that brings us to this big one, owner's equivalent rent, or OER. This thing is a huge piece of the inflation puzzle. And while it might be moving a little slower these days, it is far from dead. The Macro Butler calls it a zombie, and that's perfect. It just keeps shuffling along, keeping housing costs stubbornly, frustratingly high.
And here's the real kicker. When you look at what's called supercore inflation, this is the metric the Fed really cares about, it actually sped up again. So all this talk about mission accomplished, not even close. The whole inflation is dead story it completely evaporates when you look at the numbers that actually matter to the people in charge.
So, to get a real handle on where this is all going, we have to get out of the spreadsheets. We need to look at the real world in all its messy, chaotic glory.
And I love this quote from the Macro Butler. It just reframes the entire debate, doesn't it? It says inflation isn't just some abstract monetary thing, they printed too much money. No, it's a symptom of something much deeper. It's what happens when you have real-world shortages crashing into a total loss of trust.
And this is the three-headed dragon we're really up against. First head, shortages of actual stuff, real assets. Second head, people losing faith in the institutions that are supposed to have our backs. And the third head, policy mistakes that just keep pouring gasoline on the fire. It is an incredibly dangerous mix.
You can literally see the connection here. It's not theoretical. On the left, we've got a chaos index. On the right, the UN food price index. Look at that correlation. When chaos goes up, food prices freak out. They're like the canary in the coal mine, or as the source calls it, the economy's smoke alarm.
And guess what? It is the exact same story with electricity. When the systems that run our world start to fray, power prices don't just nudge up, they spike. This isn't just a line on a chart, it's a signal that the chaos has hit the economy's central nervous system. It's a sign of some really deep stress.
Now, this chaos, it isn't just happening by accident. The analysis we're drawing from argues that it's being fed by some really deep-rooted political failures. Failures that are basically making it impossible to find any real solutions.
I mean, just look at the world stage. It feels more unstable than ever, right? The World Economic Forum says the #1 risk everyone is worried about is conflict between nations. You throw in economic warfare, political divisions at home, and you've got a perfect storm for inflation that just won't go away.
And if we look closer to home, the picture doesn't get much prettier. We've got these massive entitlement programs that mathematically are just broken, but they're politically untouchable. Nobody wants to be the one to make the hard call. So what happens? The only solution seems to be borrow, borrow, borrow.
And what you end up with is a system that's basically stuck in permanent emergency mode. All that stimulus and deficit spending, it's not for emergencies anymore. It's just how we operate. And that leads straight to political paralysis. The tough decisions just get kicked down the road, and the bill gets handed to our kids.
Okay, so what in the world does all this mean for you, the investor, who's trying to make sense of it all? Well, it means it's time to stop listening to the fairy tales and start doing the math. Because right now, we are at a major fork in the road. And this chart lays out the two paths ahead for inflation perfectly. On one side, you have the market's fantasy.
And on the other, you have a much more likely and frankly much more sobering reality. And where you put your money, it all depends on which path you think we're heading down.
So let's break it down. Path number 1 is the Disney fairy tale. This is where inflation just magically floats back down to 2%. For that to happen, we'd need monthly numbers to average under 0.2%. With everything we've just talked about, that seems, well, unlikely. Then there's path number 2, the sobering reality. This assumes more realistic inflation prints, and it puts us on a trajectory where inflation cruises along somewhere between 2.3 and 3.5%. That first path, that's rate cuts. That's party time for markets. The second, that means higher for longer, a lot more volatility, and a much, much trickier world for investors to navigate.
And that brings us to the most important takeaway of all. In a world like this, where trust is eroding and governments are drowning in debt, the argument is pretty clear. You protect yourself with things of real substance. We're talking about looking past paper promises and focusing on resilient companies, things with real pricing power, hard assets that can't just be printed away, the stuff that holds its value when everything else feels shaky.
So let's just wrap this up. The whole Goldilocks CPI report, it's a nice story, but it's masking what's really going on. The price pressures aren't gone, they're just moving. Inflation isn't dead, it might just be gearing up for a second wave. And a lot of this is being fueled by a growing distrust in our institutions. The bottom line? It's time to get ready for a future that's probably a lot more volatile than the headlines want you to believe. Now, all the charts in this entire line of thinking come straight from a fantastic deep dive in the special service newsletter from the Macro Butler. If this is the kind of analysis you're looking for, you should absolutely check them out at themacrobutler.com, or you can even email them directly at info@themacrobutler.com. Thanks so much for tuning in.